The Governing Council today decided to lower the 3 key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. The disinflation process is well on track. Inflation has continued to develop broadly as staff expected, and the latest projections closely align with the previous inflation outlook. Staff now see headline inflation averaging 2.3% in 25, 1.9% in 26, and 2% in 27. The upward revision in headline inflation for 25 reflects stronger energy price dynamics. For inflation excluding energy and food, staff project an average of 2.2% in 25, 2% in 26, and 1.9% in 27. Most measures of underlying inflation suggest that inflation will settle at around our 2% medium-term target on a sustained basis. Domestic inflation remains high, mostly because wages and prices in certain sectors are still adjusting to the past inflation surge with a substantial delay. But wage growth is moderating as expected, and profits are partially buffering the impact on inflation. Our monetary policy is becoming meaningfully less restrictive, as our interest rate cuts are making new borrowing less expensive for firms and households, and loan growth is picking up. At the same time, a headwind to the easing of financing conditions comes from past interest rate hikes still transmitting to the stock of credit, and lending remains subdued overall. The economy faces continued challenges, and staff have again marked down their growth projections to 0.9% for 25, 1.2% for 26, and 1.3% for 27. The downward revisions for 25 and 26 reflect lower exports and ongoing weakness in investment, in part originating from high trade policy uncertainty as well as broader policy uncertainty. Rising real incomes and the gradually fading effects of our past rate hikes remain the key drivers underpinning the expected pickup in demand over time. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of rising uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So looking at the economic activity, the euro area economy likely grew modestly in the fourth quarter of 2024. The first 2 months of 25 saw a continuation of many of last year's patterns. Manufacturing is still a drag on growth, even if survey indicators are improving. High uncertainty, both at home and abroad, is holding back investment, and competitiveness challenges are weighing on exports. At the same time, services are resilient. Moreover, rising household incomes and the robust labour market are supporting a gradual pickup in consumption, although consumers' confidence is still fragile and saving rates are still high. The unemployment rate stayed at its historical low of 6.2% in January, and employment is estimated to have grown by 0.1% in the last quarter of 2024. However, demand for labour has moderated, and recent survey data suggest that employment growth was subdued in the first 2 months of 2025. Uncertainty has increased and is likely to weigh on investment and export by more than previously expected. But growth should be supported by higher incomes and lower borrowing costs. According to the staff projections, export should also be supported by rising global demand so long as trade tensions do not escalate further. Fiscal and structural policies should make the economy more productive, competitive and resilient. The European Commission's Competitiveness Compass provides a concrete roadmap for action, and its proposal should be swiftly adopted. Governments should ensure sustainable public finances in line with the EU's economic governance framework and prioritise essential growth-enhancing structural reforms and strategic investment. Looking now at inflation. Annual inflation stood at 2.4% in February, after 2.5% in January and 2.4% in December, according to Eurostat's flash estimate. Energy price inflation slowed to 0.2%, following a strong increase to 1.9% in January, from 0.1% in December. By contrast, food price inflation rose to 2.7%, from 2.3% in January and 2.6% in December. Goods inflation ticked up to 0.6%, while services inflation eased to 3.7% from 3.9% in January and 4% in December. Most indicators of underlying inflation are pointing to a sustained return of inflation to our 2% medium-term target. Domestic inflation, which closely tracks services inflation, declined in January, but it remains high, as wages and some services prices are still adjusting to the past inflation surge with a substantial delay. At the same time, recent wage negotiations point to a continued moderation in labour cost pressures. The assumption of higher energy price inflation led staff to revise up the headline inflation projection for 2025. At the same time, staff expect core inflation to continue slowing as labour cost pressures ease further and the past monetary policy tightening continues to weigh on prices. Most measures of longer-term inflation expectations continue to stand at around 2%. All of these factors will support the sustainable return of inflation to our target. Risk. The risks to economic growth remain tilted to the downside. An escalation in trade tensions would lower euro area growth by dampening exports and weakening the global economy. Ongoing uncertainty about global trade policies could drag investment down. Geopolitical tensions, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, remain a major source of uncertainty as well. Growth could be lower if the lagged effect of monetary policy tightening last longer than expected. At the same time, growth could be higher if easier financing conditions and falling inflation allow domestic consumption and investment to rebound faster. An increase in defense, in infrastructure spending, could also add to growth. Increasing friction in global trade is adding more uncertainty to the outlook for euro area inflation. A general escalation in trade tensions could see the euro depreciate and import costs rise, which would put upward pressure on inflation. At the same time, lower demand for euro area exports as a result of higher tariffs and a rerouting of exports into the euro area from countries with overcapacity would put downward pressure on inflation. Geopolitical tensions create two-sided inflation risks as regards energy markets, consumer confidence, and business investment. Extreme weather events and the unfolding climate crisis more broadly could drive up food prices by more than expected. Inflation could turn out higher if wages or profits increase by more than expected. A boost in defense and infrastructure spending could also raise inflation through its effect on aggregate demand. But inflation might surprise on the downside if monetary policy dampens demand by more than expected. Let's look at the financial and monetary conditions now. Market interest rates in the euro area decreased after our January meeting, but have risen over recent days in response to a revised outlook for fiscal policy. Our interest rate cuts are gradually making it less expensive for firms and households to borrow, and loan growth is picking up. At the same time, a headwind to the easing of financing conditions comes from past interest rate hikes still transmitting to the stock of credit, and lending remains overall subdued. The average interest rate on new loans to firms declined to 4.2% in January from 4.4% in December. By contrast, firms' cost of issuing market-based debt rose to 3.7%, 0.2 percentage point above its December level. Over the same period, the average interest rates on new mortgages declined to 3.3% from 3.4%. Growth in bank lending to firms rose to 2% in January, up from 1.7% in December, on the back of a moderate monthly flow of new loans. Growth in debt securities issued by firms rose to 3.4% in annual terms. Mortgage lending continued to rise gradually, but remained muted overall, with an annual growth rate of 1.3%. So in conclusion, the Governing Council today decided to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamic of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of rising uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission.